Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Ardelyx Inc. Annual Report. Ardelyx Inc. is a biopharmaceutical company that specializes in developing innovative medicines for unmet medical needs worldwide. The company's portfolio includes two key products: IBSRELA, a treatment for irritable bowel syndrome with constipation, and XBHOZH, a phosphate absorption inhibitor for adults with chronic kidney disease on dialysis. These two products demonstrate the company's focus on addressing specific health conditions that require effective and targeted treatments. By developing medicines that address these unmet needs, Ardelyx aims to improve patient outcomes and quality of life. With its headquarters in Waltham, Massachusetts, the company has established itself as a player in the global biopharmaceutical industry. Ardelyx's product offerings are designed to provide relief for patients suffering from gastrointestinal disorders and chronic kidney disease. The company's commitment to innovation and patient care is evident in its development of these two critical medicines. Ardelyx Inc.'s stock price has experienced a significant increase over the past year, rising by over 17.83%. The key event responsible for this surge was the company's strong Q3 2025 financial results and optimistic outlook announced on November 2, 2025. This news led to a remarkable 19% rise in pre-market trading and prompted analysts to upwardly revise their price targets. The robust third-quarter earnings report revealed total revenue of $110.3 million, a 92% year-over-year increase in IBSRELA revenue, and raised full-year IBSRELA revenue guidance. While other positive news events contributed to the company's overall stock performance, this announcement was the primary driver of the significant stock price increase. In addition to the November 2, 2025 announcement, several other notable news events led to stock increases throughout the year. These included strong second-quarter financial results in August 2025, significant price hikes for key products in January 2026, and promising FDA feedback in February 2026. However, these events did not individually cause a stock price increase exceeding 17.83%. Ardelyx Inc. market capitalization of $2 billion is materially smaller than most of its industry peers of roughly $2 billion. Ardelyx Inc. trades at a higher price-to-book ratio of 10.61 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 60% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for a company can be attributed to several key factors. Product sales, such as those from the IBSRELA segment, have been significant contributors to revenue growth. Licensing revenue, particularly from agreements with companies like Kyowa Kirin, has also played a crucial role in driving revenue upwards. Additionally, non-cash royalty revenue related to the sale of future royalties and potential development and commercialization milestones under the Fosun Pharma agreement have contributed to revenue growth. On the other hand, revenue decline can be attributed to several factors. A decrease in sales from the XBHOZH segment has been a major contributor to revenue decline. Furthermore, increased expenses such as discounts, chargebacks, rebates, wholesaler and GPO fees, COPE assistance, and returns have also led to a decline in revenue. The company's geographic market trends reveal that the United States is its dominant market, while Asia-Pacific contributes significantly due to the Kyowa-Kirin Agreement. The top customers and collaboration partners include Bioridge Pharma, LLC, which accounted for 65.9% of the company's sales in 2025, and Kyowa Kirin, a significant partner with licensing revenue and product supply revenue contributions. In terms of financial metrics, the company has seen an increase in net operating loss carryforwards from $103.6 million to $124.1 million, while amortization and depreciation have decreased from $64.2 million to $44.7 million. Tax credits have also increased from $15.5 million to $17.1 million. The net income and profit margins of a company have undergone significant changes due to various factors. One major contributor to the decline in both metrics is the elimination of Medicare reimbursement coverage for XBHOZH. This change has resulted in reduced revenue, which has negatively impacted the company's bottom line. Additionally, the introduction of new government policies such as the One Big Beautiful Bill Act and the ESRD PPS 2025 have also had a negative impact on net income and profit margins. These policies have led to reductions in Medicaid funding and changes in pharmaceutical industry revenue, further exacerbating the decline in both metrics. Furthermore, the elimination of the statutory Medicaid drug rebate cap has also contributed to the decrease in profit margins. The company's revenue growth for XBHOZH has been slower than expected, which has also had a negative impact on net income and profit margins. Lastly, the imposition of rebates under Globe and Guard proposed regulations, as well as price or patient reimbursement constraints, discounts, restrictions on product access, and importation from other countries by individual states have all contributed to the decline in both metrics. These factors have cumulatively resulted in a significant decrease in net income and profit margins for the company. The financial health of a company can be gauged by its ability to generate positive operating cash flow. Unfortunately, our analysis reveals that this particular company is struggling in this regard. According to the provided summary, the company's operating cash flow is not generating a surplus. A closer look at the financial statements on page 17 and page 18 would provide more detailed insights into the company's cash inflows and outflows. However, based on the available information, it appears that the company's expenses are outweighing its revenues, resulting in a negative operating cash flow. This is a concerning trend for any business, as it can indicate underlying issues with profitability and financial management. In conclusion, the data suggests that the company is not generating positive operating cash flow, which raises questions about its long-term sustainability and ability to meet its financial obligations. The company's debt level and interest expenses have undergone significant changes over the past few years. As of December 31, 2025, the total debt outstanding was $202,834 million, a substantial increase from $150,853 million in 2024. This represents a growth of approximately 35% in just 1 year. In terms of interest expenses, there has been a notable increase as well. The company's interest expense for 2025 was -$20,102 compared to -$13,006 in 2024 and -$4,950 in 2023. This represents an increase of 54% from 2023 to 2024 and 17% from 2024 to 2025. The significant jump in interest expenses can be attributed to the company's increased borrowing activities. In 2024, the company drew $50 million from Term D loan in October and $50 million from Term C loan in March. Additionally, a $50 million Term E loan was drawn in June 2025, contributing to the higher interest expenses in 2025. Overall, the company's debt level has increased significantly, and its interest expenses have followed suit. This trend suggests that the company is taking on more debt to finance its operations, which may have implications for its financial health and stability going forward. The management's outlook for the company is optimistic, with a focus on driving growth through product development and commercialization. The company is investing in research and development of new products, including a next-generation NHE3 inhibitor, which has potential applications across multiple therapeutic areas. This strategic approach aims to meet significant unmet medical needs and expand the company's offerings. In terms of commercialization, the management is prioritizing the launch of IBSRELA and XBHOZH, while also developing new products that can capitalize on emerging trends and opportunities. To support this growth, the company will rely increasingly on cash generated from its commercial operations to fund its operating plan. However, the management is also aware of various risks and challenges that could impact the company's performance. These include regulatory compliance issues, potential patent infringement claims, cybersecurity threats, and legislative or regulatory healthcare reforms in the U.S. To mitigate these risks, the company will maintain financial flexibility through a combination of cash generated from operations, future equity sales, and debt financing. Overall, the management strategy is centered on driving growth, managing risk, and maintaining financial stability. With a focus on product development, commercialization, and regulatory compliance, the company is well-positioned to capitalize on emerging opportunities and achieve its goals. The company's financial policies have been transparent in recent years. One notable aspect is its dividend policy. According to the extracted summary, the company has not paid dividends in any of the mentioned pages. This suggests that the company has chosen to retain its earnings rather than distribute them to shareholders. In addition to its dividend policy, the company's share buyback activities have also been scrutinized. The summary explicitly states that the company has bought back no shares, as per page 56. This indicates a deliberate decision by the company not to engage in share repurchases, which can be a strategic move to boost shareholder value or reduce outstanding shares. Supply chain disruptions and inventory buildup concerns. The extracted summaries reveal several areas of concern regarding supply chain disruptions and inventory buildup. One major issue is the reliance on a limited number of sources for raw materials necessary to make API, which could lead to production disruptions, delays, or higher costs. Furthermore, single-source contract manufacturers, CMOs, pose a significant risk, as they expose the company to delivery failure and drug shortages, with no qualified alternative source available. Additionally, supply chain disruption is mentioned as a potential concern due to various factors such as tariffs, trade policies, natural disasters, and other catastrophic events. However, it's worth noting that there are some contradictory findings regarding inventory levels. While page 82 reports an increase in raw materials and work-in-process inventory levels by 8% and 51%, respectively, from 2024 to 2025, pages 72 and 75 indicate a decrease in inventory levels and improved inventory turnover rates, respectively. Overall, while there are some concerns about supply chain disruptions, the lack of explicit mentions of inventory buildup concerns throughout the report suggests that this issue may not be as prominent. Nevertheless, it is essential for companies to address these potential risks to ensure smooth operations and minimize losses. That concludes the financial summary for Ardelyx Inc. Feel free to comment below, and I will be happy to answer them when possible.